Hello traders, and welcome back to Explain the Charts, your go-to channel for in-depth market analysis. Today, September 21st, 2025, we're taking a deep dive into the USDCAD currency pair, analyzing both the latest fundamental news and critical chart data. The currency market is abuzz with significant news, particularly surrounding central bank policies. Let's start by looking at the broader economic landscape. The Federal Reserve recently implemented its first interest rate cut of 2025, a 25 basis point reduction, with signals for two more cuts this year. This easing monetary policy is largely driven by a softening U.S. labor market, despite some strong retail sales and manufacturing data. On the inflation front, the U.S. Consumer Price Index has risen to 2.9%, with core CPI at 3.1%, both still above the Fed's 2% target. Meanwhile, the Bank of Canada is also easing rates, having cut 25 basis points this week and anticipating another cut in the fourth quarter, signaling a more aggressive stance than the Fed. Canada's economy is expected to slow, with inflation falling below its 2% target, which explains the BoC's dovish pivot. Adding to the complexity are geopolitical factors, including potential new tariffs from former President Trump on Canadian goods, which could weigh on the Canadian economy. As a commodity pair, USDCAD is also inherently sensitive to oil price fluctuations, where rising oil usually supports the CAD. These diverging monetary policies, coupled with economic data and political uncertainties, set the stage for interesting price action in USDCAD. Now, let's turn our attention to the charts to see how these fundamentals are reflected in price movements. Starting with the one-day chart, we can observe the broader trend over the past year and a half. After a period of consolidation in mid-2024, the pair saw a significant bullish rally from late August 2024, climbing from lows around 1.327 to peaks near 1.446 by mid-December 2024. This strong uptrend was likely fueled by initial market expectations of Fed strength and possibly earlier signs of Canadian economic weakness. However, you'll notice some sharp, albeit temporary, dips on this chart in October and November 2024. These appear to be data anomalies and don't reflect sustained price action. Following the December 2024 peak, USDCAD entered a clear downtrend throughout early 2025, steadily declining from the 1.44 to 1.45 region. This long-term bearish movement suggests that the market has been pricing in the anticipated rate cuts from both central banks, with CAD possibly showing some resilience or USD weakening more broadly. Currently, as of mid-September 2025, the daily chart shows the pair oscillating within a tighter range, roughly between 1.37 and 1.385, indicating a period of indecision after the sustained descent. Zooming in on the one-hour chart gives us a clearer picture of recent movements, specifically from early September 2025. We can see that the pair started September around 1.373 and, after some initial choppiness, experienced a notable upward push on September 2nd. This move saw USDCAD rally from approximately 1.3746 to as high as 1.3808, aligning with reports of USD strength following initial rate cut announcements. However, this was followed by a slight correction, and for the next few days, the pair largely consolidated. This immediate bullish reaction, then ranging, is a classic market response to significant policy changes as traders digest the implications. Now, let's get even more granular and examine the 15-minute chart, focusing on the period around the recent Bank of Canada rate cut on September 17, 2025. Here, we can distinctly see the immediate market reaction to this event. The price had been generally ranging between 1.373 and 1.375 for much of September 17th. Then, around 1750 Universal Time Coordinated on September 17th, we observe a sharp drop from 1.37627 down to a low of 1.36643. This significant bearish candle reflects the immediate weakening of the Canadian dollar as the rate cut was absorbed by the market. However, the subsequent candles show a rapid reversal, with the price quickly recovering above 1.376 and continuing to oscillate around that level. This swift recovery confirms that while the CAD initially weakened, buyers quickly stepped in, preventing a deeper plunge and suggesting a potential bounce off this lower support. This immediate dip and strong rebound provide a classic example of market volatility around central bank announcements, offering short-term trading opportunities. Looking at the current situation across all time frames, we identify several key price levels. Immediate support can be found around the 1.3700 to 1.3720 zone, which acted as a bounce point in early September and is mentioned by analysts as a long-term retest level. Stronger support is seen near 1.3626, a crucial higher low that held firm in late August, indicating persistent bullish sentiment. On the resistance side, the psychological 1.3800 handle is a significant short-term hurdle, having acted as both support and resistance recently. Beyond that, we have 1.3900, which bulls need to decisively break to assert greater control, and the 1.4000 mark, previously a contentious resistance point. The ultimate technical ceiling for this current recovery is around 1.4400, according to some longer-term forecasts. In the short term, there are reasons to be cautiously bullish for USDCAD. The US dollar has shown resilience after the Fed's rate cut, defying initial expectations, suggesting underlying strength. The Bank of Canada's more aggressive easing pace creates a divergence in interest rates, which typically favors the US dollar. Technically, the bounce from the 1.3664 low on the 15-minute chart and the holding of the 1.3750 area as support reinforce this short-term bullish view. However, the long-term outlook from some analysts suggests a potential reversion to a downward trend, possibly retesting 1.3700. Reasons to be bearish in the longer term include concerns about the U.S. labor market, elevated inflation forcing the Fed to slow its easing, and the commodity pair aspect, where a rise in oil prices could strengthen the CAD. The broader economic slowdown in Canada might be partially offset if global commodity prices, especially oil, increase significantly. To recap, the key price levels to watch are the immediate support at 1.3700 to 1.3720 and stronger support at 1.3626. On the upside, monitor resistance at 1.3800 and then 1.3900, with a major resistance at 1.4000. A sustained break above 1.3800 would reinforce short-term bullish momentum, with a 60% likelihood given the current policy divergence. Conversely, a decisive break below 1.3700 could signal the start of the anticipated long-term bearish reversal, with a 40% likelihood in the immediate term, but higher over several months. Traders should closely watch upcoming economic data from both the US and Canada, particularly employment figures and inflation reports. Any shifts in central bank rhetoric or unexpected geopolitical developments could rapidly alter these predictions. Always remember to manage your risk carefully and consider multiple perspectives when making trading decisions in this dynamic market. Thank you for watching Explain the Charts, and we'll see you in the next video.